Hello, California, and welcome to this week's edition of Your Financial Compass, the show dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio, we have two financial advisors from Bulman Wealth Group, Scott Bulman and Sean McAmoyle. Scott, Sean, it's a joy to be here with both of you today. How are you?
We're good. And speaking of joy, we were talking before the show, Chris Bulman, we threw off the set, not to be on anymore. We were admiring. Sean has a wonderful head of hair for age 62, and I'm 44. Chris is 72.
No.
And we're hoping to have the hair that Sean has when I'm that age.
Day.
So let's slow clap for that.
And when you have something nice, you want to take care of it.
That's so true. Hey,
he's got all kinds of product, like we have handlers, like he has hair handlers.
Right.
I'm a hair model. There are hand models, there are feet models.
And then there's hair models.
Chris is a calf model. He has large calves.
You guys stop picking on poor Chris. Yeah. We love you, Chris. But no, this is a great segue. When you have things, you want to take care of it, especially when it comes to your money in retirement. But the reality is we have to know how to navigate market downturns. And none of us know what the market's going to do when we don't have a crystal ball. It would be a lot easier if we did, right? Mm-hmm. So that's what we want to talk about today is steps to take during market downturns, and specifically how working with the right financial advisory team can help you navigate those downturns successfully. So first thing I want to ask about today, I think it's important to define bear markets and bull markets. We hear that terminology a lot, but what do our viewers need to understand about how the stock market actually operates?
Yeah. Well, I think bull market is a little self-explanatory. It means the market's going up. We feel good about things. We're making
the horns on a bull.
Yep.
There you go.
Yeah, that's a good. Bulls kind of raise their head up when they attack, so that kind of is an upward trend. Mm-hmm. And bears kind of, their claws move downwards, and that's indication.
I didn't know that was the meaning, but that makes a lot of sense.
It does make a lot of sense.
Wall Street trivia.
Yeah, there you go.
But, certainly a bull market people feel good about. They're making money when they get their statements or they go online. They see the account values go up, so they feel good about it. And certainly a bear market is a cause for some consternation or concern at times. But I think it's important to put it in perspective. A bear market technically is when the market goes down 20% or more. Mm-hmm. The average loss during a bear market is 36%, and I shouldn't say loss because, as we'll talk about, it doesn't mean you've lost money.
But it means it goes down on average 36% during that time.
Right. And the average bull market lasts 180 days.
Okay.
I mean, at 409 days, so a little over a year.
Okay. Yeah. So it's interesting because a lot of folks have gotten very used to the bull market. We are coming off of the longest running bull market we ever had, way past 409 days. It was 13 years, right? Mm-hmm. And then things got a little bumpy, and now here we are. And so, what is the gut response typically for investors when we have a bear market?
I think for a lot of investors and people that we're familiar with, the human nature aspect is fear. Mm-hmm. Some people a lot more so than others, which is understandable. And some people that have been investing for a while have seen this so many times, and they just, hey, I don't even look at my statements. I just kind of let it be.
I just wait it out.
Just wait it out. And there's no right or wrong answer. Everyone deals with it differently. But like for us as advisors, when we're talking to someone, it's hear them, hear the concern. It's not out of the ordinary to feel that way. You just want to make sure that someone doesn't panic and doesn't, because generally when we're emotional in any kind of decision-making situation, we make a poor choice.
Right.
We don't want to make a poor choice when it comes to our investments. So us as advisors is almost in a sense being a counselor, to hear them, because we've seen it with dozens of clients over the years, and it's like talking them through it, letting them express the fear, making sure that, hey, we're still on track. Like a lot of times advisors, just wait it out. And the typical answer, there needs to be more meat to it.
You can't just say, you're going to be fine.
Exactly.
And not address it.
Why is it doing this? Mm-hmm. Why, what are we doing? What changes need to potentially be made after you kind of hear their concern, and just letting them know there is an answer, it will come to pass, and that we're being proactive. Mm-hmm. But it can't just be, like you said, I'll just wait it out, you'll be okay. And we hear that all the time from folks coming in. Well, my advisor just, every single time this happens, they said, wait it out. Well, that's a simple answer. There's a lot more to it, and people I think people want to hear more than just that.
Well, and I don't know if you would agree with this, but I think too it depends on what stage of life you're in.
Yeah.
So when you're younger, I think it's okay to hear, oh, wait it out, because historically the stock market does come back. But if you are nearing retirement and you have significant investable assets and we hit a bear market, now the fear becomes more real because you're watching your hard-earned wealth potentially be jeopardized. And if it's right when you're planning to retire, that's a whole different ballgame.
It is. And going back to what Scott was saying about the fear of loss, I think that's just deeply ingrained in our psyche. The fear of loss is much more
I think it's
painful.
3 times the amount than the feeling of gain.
The joy of gain. But it's so deeply ingrained in our DNA. That's how our ancestors survived saber-toothed tigers, you know, knowing there's danger. I got to stay away from that. And I think what that fear of loss creates a lot of a desire for people to try to time the market.
Yes.
They feel like they see their accounts going down. I can't take this anymore. I need to get out the market, and I'll get back in at a better time. And we all know, and Scott and I talk about this all the time, that trying to time the market is the worst thing someone can do.
Yes.
The old adage is time in the market is better than timing the market.
Yeah.
You always hear the story of someone, oh, I got out of the right time, got back in at the perfect time. A dead alarm clock's right twice a day. It's going to happen sometimes. It's luck. We don't try to time the market.
No, for sure not, because you lock in that loss if you jump out.
Right.
Yeah.
Recently had a client, or a new client came to us, very highly educated, experienced person who had been managing the family's money for a long time, and he finally admitted that I need someone that I can count on, that I can lean on for a second opinion, that will keep me from doing things that I've done in the past, bad decisions. One of the main reasons they were seeking an advisor was to keep themselves from making a bad decision.
Yes. Well, and that's so helpful because a lot of times we are too close to our own stuff and there's a lot of emotion. And so to be able to have that independent, objective, third-party view who can look at the whole big picture and help make sure that folks are staying on track to reach their goals despite what the market may or may not be doing is incredibly beneficial. So during a bear market, what do you recommend folks do? So we already established that jumping in and jumping out is not the right answer. So how do you help folks navigate those times?
Well, as we were saying earlier, and as you referenced, is some of it depends on the stage of life. So if it's a younger person, again, you can kind of wait it out. You still talk about it, but we're not going to panic. The majority of folks we deal with, though, are a little bit further down the road in terms of closer to retirement, maybe 55 and older. And in those instances, you want to reevaluate, hey, if you're retiring in 2 years, kind of reassessing where the portfolio is now. How are you currently invested? Is it too aggressive? Do we need to kind of rein it in? As I like to say, pull a little spice out of the meal. Maybe have someone take another risk test. We always do that just to get an updated feel for the risk tolerance to make sure is it still in alignment with the portfolio. Again, we don't want to make dramatic changes, but sometimes some tweaks are necessary. So we just have to kind of reevaluate the goals, the timeline, all those different things.
Yeah, for sure.
You know, our approach to financial planning is we think about money in at least 3 different categories. There's the safety bucket, the income bucket, and the growth bucket. And I think a lot of people, when they think about their portfolio as one big kind of pile of money or pot of money, and they see that going down, it even exasperates some of their concerns. But when they understand that each bucket has a different purpose, I think it puts it in perspective that if they know they've got their safety money, their emergency money set aside, if they know they've got 5 to 7 years of income set aside, that they can ride out these periods of volatility. And in fact, what I tell people all the time is that volatility is the fee we pay to get those long-term 8 to 10% returns that the equity markets can give us. It's just simply the fee we have to pay is to stomach these bear markets.
Right.
It's like going on a trip. We all like to travel. You fly to Europe. It's so much fun. The plane flight stinks.
Right.
So
but you got to do it, right?
Yeah, exactly.
Well, no doubt, I'm sure a lot of folks watching today can relate to that story that you shared of someone who came in recently and said, please help me take the reins of this. If someone's out there watching and going, yeah, I have been handling this on my own, but I know that I need help, what would you want to say to them?
We'd say to them, we hear you, and let's just have a conversation. Let's start to see what those concerns are. Maybe it's risk, maybe it's income, maybe it's taxes, maybe it's all of the above, legacy planning. And the first step to do is you can call the number below. You can click on the QR code, and someone from our office will give you a ring, and we'll talk and find out more about your situation, and maybe it gets to a point of talking to one of us. But a lot of times people just want to be heard, and they want to feel like they're not going to be talked down to, you're not going to be talked down to, and all those are stupid questions. And let's understand the situation, add some color and clarity to the picture, and see where it leads us in terms of potentially helping you out.
Wonderful. Well, Scott, Sean, thank you. I'm excited to continue the conversation with you, but this is an excellent time for you all to reach out and receive the opportunity to get your complimentary financial compass review from the team of Bulman Wealth Group. To claim yours, simply call the number on the bottom of your screen, 888-970-4685. Or if you'd rather connect online, if you simply pull out your smartphone, you can open up that camera app, just point, click, and scan that QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Bulman Wealth Group will reach out to connect with you to schedule your complimentary review that way as well. When we come back, we're going to be diving into some more strategies to help you successfully navigate a bear market right after this.
Successful retirement to me is someone who doesn't have to worry about where their next paycheck's going to come from, where the income's going to come from. Are they going to run out of income? Are they going to run out of money? Are they going to meet their financial goals with respect to maybe they want to leave money to their children? Maybe they want to leave money to a philanthropy or a university.
Being able to wake up and know the day's an open slate and not having to worry about things. Or say someone's going on a trip with family, they're going to the beach, and if the headline says, the market's down again or something, they're not concerned. Bulman Wealth has my back here. We've got a plan in place. My portfolio is set up in a way that concern is not there.
All the pieces fit together like a puzzle. When that all fits together and you can see the peace of mind that gives families, that is a successful retirement.
As Americans, we strive for better, from a better house to a better career to a better life for our kids. Better has become the American way. But when it comes to your retirement, what does better mean to you? More income, a flexible lifestyle, better solutions? A better retirement begins with a plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity to plan for better.
Well, welcome back to Your Financial Compass. I'm Kristen Oakley here with both Sean and Scott, financial advisors from Bulman Wealth Group, and we are discussing today what you need to know and understand about a bear market. What strategies can you employ to safeguard your hard-earned net worth during volatile market times? So, we talked about earlier, it really can depend on the age and stage of life you're in, how this market volatility can affect you. And I know that this is what you help navigate folks through. A lot of times people, as you said, just need to talk it through, talk it out. But what are some other strategies that you want our viewers to keep in mind during bear markets?
Well, you'd asked a question earlier about what should someone do who's a couple of years from retirement. They can see it, they can see the end goal in sight, and then we hit a bear market. And we talk a lot at Bulman Wealth Group about it's called a sequence of withdrawals. And studies have shown that if you happen to retire have bad timing, retire right when a bear market hits, and you start withdrawing money from your portfolio, the dramatic negative impact that can have.
It's a double whammy.
It's like a boat leaking from both sides.
Yeah.
Right.
So as we talk to people who are getting a year, 2 years before retirement, the market's at an all-time high. We start implementing some strategies that can protect principal to kind of put some belt and suspenders around their portfolio as they enter those first few years of retirement to ensure that if a bear market does hit, that it doesn't negatively impact their portfolio.
Like you said, it's a leaking boat from both sides, right?
Yeah.
That's a good way to put it for sure. How about, what are some other strategies?
Another thing that we've seen a lot, we've done a lot, is, and something to ponder, is something called an in-service distribution or an in-service rollover. And that's a fancy way of saying if you're over the age of 59 and a half and you're still working, there's an option you have to roll a portion of your 401k. Say you've got a 401k at your workplace, and let's just put it into context. And generally most 401ks are going to have 15 to 25 fund options.
Right.
Kind of generic, but that's just, it is what it is. Generally high cost mutual funds. But there's a lot more features out there with an advisor's going to have all these extra tools where instead of 25, there might be thousands of funds to utilize.
Options, yeah.
So what you can do or consider doing, especially if you're working with an advisor, is you can roll a portion of that 401k out if you're over 59 and a half and roll it into an IRA. And then from there, as Sean said, all these different tools that could be utilized, maybe to reduce risk, compartmentalize a bit differently. That's a really big thing, and we've seen this many times, and this might be you at home, like, gosh, I'm a year from retirement, a couple years, I've got all this money in my 401k, I don't love the options, I'd like to have someone directly manage it. That's something you can consider. It does not trigger a taxable event.
That's
a lot
huge.
of times people ask, what's the tax burden? There's none. Think of it moving from one pocket to the other.
Right,
So
like to like.
Like to like.
Yeah.
So as long as it's not coming to your hands, but it's moving from a 401k to a traditional IRA, it's not a taxable event, and it just opens up a plethora of other options.
Yeah, it gives you more options. It gives you more control over your money. And again, that key age is age 59 and a half. You don't want to try to do this prior to that because you'll be hit with an early withdrawal penalty of 10%. So that's why age 59 and a half, it's interesting. We've talked about this before, but that half birthday age, right? That's a key, very important for the day for folks. Well, let's talk about rebalancing though too, because this is what a lot of people found out in 08 the hard way. Right? So typically when your portfolio is doing really well and you see it growing, you want it to keep growing. It can be really hard to sell off when things are high, right? And buy some more of the losers in your portfolio. But if you do that correctly, what in essence are you actually doing?
Well, you're really implementing a disciplined approach of doing what we always want to do, is sell high and buy low, right? And so at Bulman Wealth Group, we meet with our clients at least quarterly. And then based on the needs and the goals of the client, we determine how often do we need to rebalance. Quarterly sometimes works for some clients. Other clients, it may be every 6 months or a year, depends on what the market's doing as well. But we put in place a very disciplined approach of when and how we're going to do rebalancing. And that just simply ensures that for those asset classes that have really had a run up, it's an opportunity to sell those at their peak and then reallocate that money to some of those other asset classes that have been underperforming and that have really been impacted by the bear market. And over time, it really evens out the volatility that they experience, and we get a better result from their investment performance.
And that takes that disciplined approach. I think that's why it's helpful to have that third party navigate you through that, because it's hard to pull the trigger. But to your point, everybody wants to know how to buy low and sell high. Well, guess how you do that? You sell high and buy low. You have to sell off some of the winners, maybe buy some of the underperformers, but that's how you do it.
It is, and again, Sean always says this: part-time versus full-time. We're full-time. We do. This is our job.
This is what you do.
We cannot show up at your job and be a nurse or whatever it is you do. But give yourself a little grace, because you were doing this part-time. A lot of folks only look at their statement once a year or once a quarter when it shows up. Some people every day. But one reason to ponder working with an advisor is that disciplined approach, as we've all said. Sometimes you need someone else. You're going to hear it differently as opposed to your spouse saying it or your child's like, I need to hear this person saying it. And if you're looking for someone to help kind of navigate that for you or answer those tough questions or just put how does everything fit into a context, into a plan, well, that's really one reason you should call the number below. You see that number, you see the QR code, you can scan that. We can set up a time to talk and answer these questions or any kind of financially related questions you have.
And the best part is it's completely complimentary for no cost. So we invite you to reach out. Again, that number number to call is 888-970-4685. Or again, you're welcome to scan that QR code and that will get you connected as well. Stay with us. We're going to talk about some more strategies for you right after this.
After college, I spent 8 years active duty as an Army officer, as a captain in the Army. And I was really driven by this idea of service and serving something bigger than myself. And when I got out of the military, it was an easy transition to financial services as a financial advisor. There was a firm that was looking for military officers who had just gotten out. They had done a study, and the people that served in the military tended to do well in financial services. And once I got into it, I just really fell in love with not only working with clients, but building portfolios, the strategic part. Just like in the military, a military operation, you're here today and later you want to get to this destination. How are you going to get there safely? Planning all the logistics, the danger areas, planning around those. They just related to each other in a way that just made sense for me. And this feeling of serving clients, serving others that's bigger than myself became kind of my calling, just as serving in the military was my calling.
As Americans, we strive for better. Better house, better career, to better the lives of our kids. Better's become the American way. But when it comes to your retirement, what does better mean to you? More income, flexible lifestyle, better solutions? A better retirement begins with a plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity. Plan for better.
Welcome back to Your Financial Compass, where today we are discussing strategies to help you successfully navigate a bear market. Here's the reality. The stock market only does one of two things. It goes up, it goes down. We have to know how to handle those downturns appropriately. And again, we've talked about a lot of different strategies today. I know there's a huge one that you want to make sure our viewers understand. So Scott, take it away.
Yeah, so one of the things that is always worth pondering in any situation, let alone when the market is down, is something called a Roth conversion. Mm-hmm. So in essence, think of it, if you've got a lot of money in a traditional 401k or traditional IRA, remember that money has never been taxed. So when you pull the money out, all will be taxed as income. So a lot of times we look into doing what's called a Roth conversion, where you pull money from that traditional IRA and you can roll it into a Roth IRA. You're getting the taxes out of the way now. So then everything you put into the Roth IRA, all the future gains are tax-free. Well, I always love to ponder that idea, but when the market is down, technically you can convert a larger portion of your portfolio, if it's dropped, for the same tax cost. So it always makes sense to look into, but especially when the market's down, you can get a little bit more bang for your buck per se to consider converting then, because of the drop in value, converting a larger portion for the same tax cost.
Yeah, and that way you're getting that money moved from the taxed always to the taxed never again bucket,
yep.
right?
That's the best place to be, in my opinion.
Well, speaking of taxes, I know there's another strategy that I think a lot of folks have heard of, but there's a lot of confusion surrounding it. Tax loss harvesting. Can you shed some light on what that actually is and who that might apply to?
Sure. So I think it's so important that clients look at the results of their portfolio really on a net basis, after fees, after taxes, what return did they get? That's what they've really kept. And during bear markets, there are opportunities to go into the portfolio, make some really smart tax planning decisions. So what tax loss harvesting means is that you can take losses. No one likes losses, but you can strategically time and create losses in a portfolio to clean the portfolio up, but you get to write those losses off against realized gains that you've had. So a simple example is if you, during the course of the year, you sold some stocks for a profit. Let's say you made $20,000 in profit, but within the portfolio there were some underperforming stocks or assets. We sold those for a $25,000 loss. You're able to write the $20,000 of the $25,000 loss against that $20,000 gain, essentially pay no taxes on that gain, and now you have $5,000 left over of losses. those losses can then be carried over and count $3,000 can be deducted from your ordinary income. Now you still have $2,000 left in that loss bank that can carry over to the next year.
Wow.
So tax loss harvesting becomes a very strategic technique that we use at Bulman Wealth Group to create more after-tax returns for our clients.
And as I'm listening to you describe these strategies and techniques, it just blows me away. It's such a blessing that you're on top of this for your clients. I mean, for each and every one of them, how often are you reviewing and looking for these types of tax-saving strategies?
Well, it becomes really important towards year end.
Yeah.
We're always, as we're rebalancing, again, you're selling some of those winners.
Right.
You're buying some losers. So you are creating some capital gains in many cases. And so as we get closer to the end of the year, we're very sensitive to what those gains are and where can we create some losses strategically to lower that tax bill for our clients.
And one quick thing to mention, and Sean mentioned end of the year, we had talked about Roth conversions earlier.
Right.
Well, if you're contributing to a Roth IRA or a traditional IRA, a contribution, you can do that all the way to tax time of the next year. For a Roth conversion, it has to be done that year.
Calendar year, yeah.
If you're running up towards the end of the year and you're debating if you should do it, you can't wait into the next year to do it to count for that current year like you would be a contribution. So it's just a little
important to
nuance.
check in. And again, that's why working with an advisor can be so helpful to make sure you're on track to do the different things you need to be doing at the right time of the year. I also know that you all work with a lot of folks who are charitably inclined. So talk really briefly about how charitable giving can also be another strategy.
Well, it becomes another year-end consideration. During the course of the year, each individual can gift up to $18,000 to anybody. So a couple can gift $36,000 to friends, family members, to Scott, to myself.
And Sean promised me a gift, so I'm looking forward to it.
Sign me up too. No, I'm just kidding.
The recipient does not pay any taxes, but where there's an opportunity where you may have some assets that have depreciated because of the bear market, you can gift those assets in kind to someone else, and then they get the opportunity to experience the recovery of those assets and see the real growth. It just becomes a really tax-efficient way to pass on assets to the next generation.
Well, I always learn something new when I'm with both of you. Sean, Scott, thank you so much, and thank you to our viewers for joining us. But this is the reality. Now is the time to be looking at your accounts and seeing how you can take advantage of some of these strategies even before a bear market might happen. And so we encourage you don't have to go it alone. We want you to reach out and get your complimentary financial compass review. 888-970-4685, or you can scan that QR code. That will get you connected as well. We look forward to being back with you next time here on Your Financial Compass.